Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can better understand what we see in the global landscape. You know, we continue to see interest rates in the U.S. rise even more. In fact, as of yesterday, we saw basically the 10-year hit an all-time high for this year in interest rates. So rates are slowly moving up. I've talked about those repeatedly, not only on my TV and radio show, but also on these updates. And of course, our clients are well protected. We're on the right side of the fence when it comes to interest rate and fixed income investing. I would urge that individuals watching this update video who are not clients should seriously take a look at your portfolio to see what you need to trim and make adjustments to on the fixed income side. Primarily at Resney Wealth Management, we own floating rate security ETFs or mutual funds. And the reason we own floating rate income-oriented investments is simple. These are very short-term duration. In fact, they're going to be the shortest duration of most income-oriented investments. When rates go up, the rate on our portfolio can actually go up without causing a negative decrease in value. So in essence, like a teeter-totter, when rates go up, bond values go down. The closer you are into the center of that teeter-totter, which we are about as close as you're going to be, you get very little, if at all, movement in the downside. But we can get the higher interest rate on our portfolio as rates go up. So that's exactly the place we want to be right now. And again, if you're not a client, I would suggest you take a look at that portfolio or call our office for a consultation. On our global tactical portfolios across the board, as of a few days ago, we added emerging markets back into our portfolio. As most of our clients realize, we haven't really had much exposure into emerging markets most of this year, simply because they started getting relatively weak throughout the year up until about 2 or 3 weeks ago. As emerging markets started to bottom, and by the way, most emerging market sectors were down anywhere from around 25% negative year to date, down to around 10 to 12% negative year to date, in that range, while the U.S. was up around 12% on a lot of the sectors year to date. So that's a pretty big variance. You're talking 25% of some emerging market sectors down negative. The U.S. is up 12. You're talking a 30% change in valuation. The reason we run relative strength, simple. It works over periods of time. It doesn't work every single day, and it doesn't work every single month, and sometimes we'll lag a little bit, but we're going to accept that as a money manager in order to protect our clients' big principal from major declines. At the end of the day, emerging markets, in our opinion, have started to bottom. We're starting to see relative strength coming off that market bottom, and we had confirmed buys within our strategy. We added emerging markets back into our portfolios as one of our core positions in all of our global tactical portfolios, and so far it's treating us well. I firmly believe in what we're seeing in the emerging market economies is improvement. We're seeing improvement in all the metrics almost across the board on most of the broad-based emerging market economies. This is a net positive not only for them and their markets, but it actually is a net positive for the U.S. Not to mention in the U.S. we continue to see slow improvements. Again, one of the things that I want to talk about is the most hated rally we've probably seen in the U.S. stock market and all markets around the world. Investors, unfortunately, base their decision often on emotion instead of real logic and a real strategy. At the end of the day, emotions will get you into trouble. A real logic and real strategy, in my opinion, will help you make returns and protect the principal. We're seeing improvements in the economies around the world. As we continue to see improvements in the economies, that means corporations make more money. That means typically the stock markets in those economies and countries do better. And that means investors who are invested in assets that truly can grow in value are going to be well rewarded. I firmly believe the next 3 to 5 years in the equity markets are going to be promising. Some will be better than others, and we're going to hopefully be on the right side of that fence in which economies are better. And I firmly believe traditional fixed income investors, people who keep buying muni bonds, intermediate and long-dated muni bonds, mutual funds, and the like, are going to be hurt. These investors are going to lose more money and make lackluster returns over the next 3 to 5 years, as I firmly believe the Fed will start winding down its QE2 or tapering their bond purchase program in the months ahead. That's going to basically slowly raise rates, and it's going to hurt fixed income. So again, clients of Resney Wealth Management, you don't have to worry because we've already done our job. But if you're not a client of Resney Wealth Management, you definitely want to take a second look at that portfolio, or better yet, call our office for a consultation. We always like taking on new clients. We're nice people to do business with. Of course, if you're a client and you have a question about your portfolio, give us a call. Let's talk about your needs and your questions and get those answered. If you're not a client, call us for a consultation. There is a difference. We do invite you to experience it. This Sunday, by the way, we do have a live radio show throughout Florida from 10 a.m. Eastern to noon, and we also have a live TV show tonight in Southwest Florida. If you can't catch our TV show, it will be uploaded on our website by noon tomorrow. So you can go to our media tab, click on it, and actually watch my live TV show from tonight if you're not in the viewing area. Again, make sure you have yourself a safe and profitable day.